Hello everyone and welcome back to these sessions on quantitative methods for CFA level 1. Now in this class, in extension to the topic time value of money, we will be talking about components of interest rate. Now you know the discount rate or the interest rate, which we also consider as the required rate of return or expected rate of return. What is the point of origin of this? From where does it come? Now, for example, US government treasury bills, which we also call as T-bills, these offer some rate of return which is considered as risk-free rate of return. Why do we consider that as risk-free rate of return? Because no matter what happens in the financial markets, but US government will be consistently making the payment of interest on that treasury bill as the defined rate exists. So in the money market, the treasury bills will be considered as a risk-free investment. So you know one thing, what is the difference between a bond issued by US government and a treasury bill issued by US government? Treasury bill is always for a shorter span of time, whereas bond is for a longer duration. So what happens? Both the rates of returns on treasury bill as well as US government bonds will be considered as risk-free rates. But you understand one thing, risk-free rate in money market and risk-free rate in bond market are two different rates. It all depends on whether you are an investor in money market or you are an investor in bond market. Accordingly, you have to pick the right rate of return for yourself, which will become the base for expected rate of return. Now, this risk-free rate that we are talking about, when you make an investment and that investment happens to be a risky investment where some kind of risk factors are included, you are not going to expect just the risk-free rate. You would want a little higher rate, correct? For example, if US government bond is offering me 6% coupon rate. So 6% coupon rate offered by US government bonds will be considered as a risk-free rate in the bond market. But if I am investing in bond of another corporate entity which is not representing government, that corporate entity's bond may carry certain degree of risk, and we will not expect just 6% rate of return on such bonds because these bonds are having some risk elements involved, and therefore the rate of return expected on such bond will be obviously higher than the rate of interest offered by US government bonds. As a result, you are going to consider the presence of risk in these corporate entities bonds, and you will have to make adjustments towards risk premium, and that is where you will arrive at a rate called as a risk adjusted discounting rate, which will be basically a nominal discounting rate. So a nominal discounting rate will be a complete risk adjusted rate. It will also include the inflation adjustment. Now what is this inflation adjustment? See here, when we talk about interest rate, we have to be clear about one thing, that there are two types of interest rates. One is what we call as the real interest rate, and another is what we call as nominal interest rate. Now what is the difference between real interest rate and nominal interest rate? Real interest rate is the interest rate without any inflation adjustment, means inflation factor is not included over there. Whereas under a nominal interest rate, inflation factor is included. So we are going to pick the real interest rate. To that we will make inflation adjustment, arrive at nominal interest rate, which is still a risk-free interest rate, and then we make risk adjustment to that to arrive at the appropriate required rate of return. So your appropriate required rate of return, which is going to become your discounting rate, will be the real risk-free interest rate plus two types of adjustments, adjustment of inflation and adjustment of the risk. So for adjustment of inflation, we add inflation premium. For adjustment of risk, we add risk premium. So let us try to understand the whole point in little details, but please write this heading first of all as components of interest rate. So once you have written this heading, components of interest rate, let me put forward this as a question, that is, explain an interest rate as the sum of a real risk-free rate and premiums that compensate investors for bearing distinct types of risk. So the required interest rate on a security will be the real risk-free rate plus inflation premium and plus the adjustments towards the risk. So as I have explained to you earlier, we have two types of risk-free rates. One is the real risk-free rate, one is the nominal risk-free rate. What is the difference between these two? The adjustment of inflation, once you carry out on the real risk-free interest rate, it becomes a nominal risk-free interest rate. So you can see over here what I have written, real risk-free rate plus inflation premium will give you the inflation adjustment. The rate will become the nominal risk-free rate, but it is still a risk-free rate, so risk adjustment will be required. So we first add the premium towards default risk. What is the risk of default? So it is assumed that if it is a bond which is issued by US government is not going to default. That is an assumption, and that is why we consider that as risk free. Now because the government is not going to make a default, it is completely free from that risk, but any bond of any other corporate entity which may not be having that credit worthiness can have the risk of default. And that is where, because of presence of such risk, the investor in such bonds will be expecting a little higher rate of return, and that is where on the risk free rate you need to make adjustment of risk premium towards default. The second component is the liquidity premium. Now see what happens. Certain instruments or certain securities, they are traded in financial markets which are highly liquid. So where liquidity is existing, you don't bother about the liquidity risk premium. In that case, you don't have to consider the adjustment of liquidity risk premium. What if your investment made is in such a security which is not traded in financial markets actively? For example, there is an individual corporate loan given by one bank to a corporate entity. In that case, the corporate entity is the borrower and the bank is the investor. Now, bank cannot trade off this loan to some other entity just like that. If the bank has made an investment, liquidity becomes a question mark over there. Bank has no choice but to wait for the tenor of the loan to get over, and whatever be the cash flows promised by the borrower to the bank, that cash flow will happen over the period or over the life of the loan, but this may not be considered as a liquid investment. If you want to encash it, you might have to pay some charges or some penalty, or you have to consider a lesser realizable value compared to the amount of loan actually given. This is the risk arising because of lack of liquidity. When there is lack of liquidity, you are not in a position to encash your investment on immediate basis, and that risk is called liquidity risk, and the adjustment of premium for such risk is called liquidity risk premium. The next one is maturity risk premium. Now it is considered that longer the maturity of the bond, the longer will be its waiting period for the investor to get back the money, correct? So assume that a bond has a life of 5 years and there is another bond that has a life of 10 years. The redemption of that bond will happen at the end of its life in either case. A 5-year bond will pay you back the par value at end of 5 years, whereas a 10-year bond will pay you back that same amount after 10 years. Now, simple logic is, what happens when there is fluctuation of interest rate? When there is fluctuation of interest rate, what will I do for computation of the present value of the redemption amount of that bond? In other words, the maturity value of the bond when converted to its present value, what factor will we apply? It is just what we have learned in the earlier class about the time value of money. So, we will take 1 plus I raised to minus n. Now, if I, that is the rate of interest, is fluctuating, the interest rate fluctuation will definitely bring risk. But that risk is not this maturity risk. Maturity risk is something different. I am coming to that. See, interest rate will fluctuate. So, what happens when you take 1 plus I raised to minus n? It is basically 1 divided by 1 plus I raised to n. It is the reciprocal of 1 plus I raised to n. So, if interest rate is fluctuating substantially and n value is 5 years, the impact of the fluctuation on that bond price will be little lower. But if the maturity is extended to 10 years, the fluctuation will have greater impact on the bond value because the time horizon, the waiting period is longer. Longer the waiting period, bigger is the risk of price fluctuation because you have to keep waiting for the maturity time. So, longer the maturity, higher is the risk. That adjustment when you make to the risk-free rate, that is towards the maturity risk where you are applying that adjustment. So, maturity risk premium will be the third component of risk that you are adjusting. So, the real risk-free rate of interest is a theoretical rate without the adjustment of inflation in that. So, we are first going to write about the real risk-free interest rate, and then I will give you a note on nominal risk-free interest rate. So, just to recap what we have discussed in past 5 minutes, I would say you begin with a real risk-free interest rate. To that you make inflation adjustment to arrive at nominal risk-free interest rate. Then you make adjustment of risk and you arrive at the final required rate of return, that is risk-adjusted rate of return. That risk-adjusted rate of return will be the nominal risk-free interest rate plus risk adjustment. That risk adjustment or risk premium is because of 3 types of risk that we have considered over here. One is the default risk, one is the liquidity risk, and one is the maturity risk. So, for each component of risk you add or adjust a suitable degree of premium. So, your risk-free rate plus something is going to become a risk-adjusted rate, and risk-adjusted rate obviously will be higher than the risk-free rate. So, quickly write up these initial lines and then I take you ahead. Alright friends, once you have completed writing this whole thing, let me once again talk about this last line because this is something very, very important. So, when we talk about inflation adjustment, we are basically dealing with 2 types of risk-free rates, real risk-free rate and nominal risk-free rate. Difference between these two is that the real risk-free rate is inflation-free interest rate, pure interest rate, whereas the nominal risk-free rate is the inflation-adjusted risk-free rate. Now, you know one thing, in this line, which I am calling as an important line, I have mentioned that the real risk-free rate is a theoretical rate. In real life, it won't exist. Why it won't exist in real life? See what happens. Suppose you go and make an investment in bank's fixed deposit. Bank will offer you say 6% interest rate. Now we observe one thing, that on an average in say US economy there is a 3% inflation observed. That means logically, if bank is giving you some interest on the money that you have invested, they have compensated you not only towards the value of your money, but even towards the inflation. Let me give you a little elaborate example. For example, say you have invested $100 now just for a period of 1 year, and the bank is offering you 6% interest rate on this 1 year deposit. So you deposited your $100 with bank is going to give you $106. Now say your plan was to buy something which is available for $100, but you are postponing your expenditure by 1 year, so that because you don't need that thing right away, you are postponing your expenditure by 1 year, and your plan goes this way, that okay fine, if I buy this commodity now, I have to pay $100 which I already have in my pocket. But if I buy it after 1 year, what I will do during this 1 year, I will not keep this $100 idle. I will deposit the same with the bank. Bank will give me 6% interest on that. So the maturity value of my investment is going to be $106. If I am going to receive $106, obviously I will be spending $100 for buying that thing, and $6 will be some extra income in my pocket. Now what happens after 1 year? You deposited $100 at the beginning of the year. Bank will definitely give you the amount as promised, because even when you are investing money with bank, it is treated as good as a risk-free investment. So bank will definitely give you 6% interest on your $100 deposit. So they will give you back $106. Till that, your plan worked exactly the way you have thought. When you go and buy that commodity, you come to know that because of inflation of 3% prevailing in the economy, what was available at $100 1 year back, now it is available at $103. Because of 3% inflation, the price has risen to $103. So what was your expectation that you will be earning some interest over this period? Now you observe one thing. How much money you will pay to buy that commodity? $103. And what was the receipt from bank's maturity value of deposit? That was $106. So what is the final amount of money that left in your pocket? Just $3. That $3 is actually the pure interest that you have earned, because other $3 what was given by bank was just a compensation against inflation. So guys, understand one thing. When bank is offering you 6% rate, bank is not telling you that okay, hey investor, you have deposited $100 with us, we will give you $3 towards interest and $3 towards inflation adjustment, or as a compensation towards inflation. Bank is not going to give you that split. We are determining that split. That is why the line written over here, that the real risk-free rate is a theoretical rate, because whether it is bank or US government treasury bill or US government bonds, when they offer some rate of return on such investment, it is indeed the risk-free rate without doubts, but it is after inclusion of inflation adjustment. Means the rate of interest offered on these investments are nominal risk-free rates, not real risk-free rates. So real risk-free rate is therefore considered as a theoretical rate. So I'm sure you understood the relevance of that last line what you have written, and now allow me to take you ahead and discuss something very, very important further. The rate of interest observed on US treasury bills, that is T-bills, are risk-free rates but not real rates of return. T-bill rates are nominal risk-free rates because they include the adjustment of inflation premium. Now we know one thing, that nominal risk-free rate will be the real risk-free rate plus inflation premium. Once nominal risk-free rate is determined after the adjustment of inflation premium, the next step will be to adjust the risk premium. So the required rate of interest on a security or required interest rate on a security will be nominal risk-free rate plus risk premium. So please write up this part as well, and then I take you ahead. Alright friends, once you have completed writing this whole thing, let me take you ahead and please write further. Securities may have one or more types of risk, and each added risk increases the required rate of return on the security. These types of risks are default risk, liquidity risk, and maturity risk. I have already explained to you all these three types of risks in details. So please just write up this note quickly and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and now talk about adjustment of inflation. So as we have learned one thing very clearly, that first you pick a theoretical risk-free rate, which is the real risk-free rate, and to that you make inflation adjustment to arrive at the inflation adjusted risk-free rate or nominal risk-free rate. And as I told you that government bonds, banks on their fixed deposits, treasury bills, the rate of interest offered on these are basically the nominal risk-free rate. So gap between the real risk-free rate and nominal risk-free rate is basically going to be inflation adjustment. Now let us consider a different example. Suppose I say that real risk-free rate is 5% and inflation premium is 3%. So what should be the nominal risk-free rate? Anyone will say, okay, nominal risk-free rate will be what? 5, which is real risk-free rate, plus inflation premium, that is 3%, 5% plus 3% added, it becomes 8%. When you do this, as such it is not wrong, but it is not that appropriate. The real way of adjusting the inflation premium is what we have to now discuss. And how to deal with that, let me explain this through an example. So you would find that this particular example given in your book, it says you want to invest $10,000 today for 1 year. Pure interest rate that you expect is 10% per annum. Inflation rate is given as 8% per annum. What will be the inflation adjusted interest rate that you need to earn? Now the example is given in your book, you need not write this example, but the response to this you will have to note it down. But first tell me one thing, when we are dealing with this particular aspect, this particular example is giving you a glimpse of risk-free rate as 10%, which is risk-free real rate, and separately informing you that inflation rate is 8%. The question doesn't say inflation premium, it is saying inflation rate. Now inflation rate should never be directly added to the risk-free real rate or real risk-free rate to arrive at the inflation adjusted rate. It will not be appropriate. So how to deal with this, let me explain to you in detail. So how much money you invested today, the amount invested in US dollar was the initial amount of 10,000 US dollar. Now on this you first add your real interest what you want to earn. The real interest that you want to earn is 10%. So 10% of $10,000 will give you $1,000 added, and what you get is 11,000 as the future value. So $11,000 is the future value, but it is the real cash flow in future without considering any inflation adjustment, because that 11,000 should be your receipt in hand, after 1 year without considering inflation adjustment. Now they have given the inflation rate as 8%, so you are going to add the inflation adjustment at 8%, but not 8% on $10,000. That will be 8% on this cumulative value, that is $11,000, and that would not be simply $800, it will be $880. So you understand one thing. When you directly take aggregate of 10 plus 8, which is equal to 18%, you know what is the error that is arising over there? 10 plus 8 equals to 18%. Over there you are applying 10% on $10,000 and 8% also on $10,000, which is not appropriate. See, inflation and interest dual adjustment when you are making, it is the principal amount invested today at present value plus the real interest rate, which will make the outcome as the real cash flow after 1 year. Now what is this real cash flow? It is a cash flow based on the prices prevailing now. So what do we mean by prices prevailing now? When I say the future cash flow based on the current price level, I repeat, future cash flow but based on the current price level, that is the real cash flow, because the gap from that present value and future value is pure interest gap only. Inflation is not adjusted. Then you separately make inflation adjustment. That time it will be 8% of the future value, not 8% of the present value, because your inflation will affect all the money that you are going to receive, correct? It is not going to just affect the principal amount, it is also going to affect the interest amount, because fact is what? Interest also you are going to receive after 1 year. Nobody is going to pay you interest right away. Interest you are going to receive along with your investment after 1 year. As a result, your entire inflation adjustment of 8% will happen over that $11,000, and 8% of $11,000 will be $880. As a result, the total monetary value to be received after 1 year, that will be with inflation adjustment, becomes 11,880. So what rate of return you should expect, which is an inflation adjusted interest rate? It will be $10,000 of today is becoming $11,880. So you simply apply the rule of P1 minus P0 divided by P0, that today's 10,000 is expected to become 11,880. So the gap between the two values, that spread or the difference between the present value and future value, which is combined effect of interest and inflation, it is 1,880. So when you convert that into percentage, it comes to 18.8%. If you would have directly taken 10 plus 8, 18%, it would have gone fundamentally wrong. So let's do one thing. Let us write up this whole thing and then I take you ahead. Alright friends, I am sure you have completed writing this whole thing. Now let us talk about some more interesting facts over here. Look at this $10,000 value at the beginning, correct? On the first line, what I am writing, principal invested, that amount is $10,000. What is this value? This is present value. Can you tell me what is this $11,000? Is it a present value? No, it is a future value. What about this 11,880? Even that is the future value. So $10,000 definitely is a present value, but both the values 11,000 as well as 11,880 both are future values. But look at this 11,000. This is a future cash flow without inflation adjustment. This will be called real cash flow. This 11,880 is also future cash flow along with inflation adjustment. So this will be called money cash flow or nominal cash flow. Now how do we distinguish these two future cash flows? One is real cash flow, one is nominal cash flow. Real cash flow is the future cash flow based on prices prevailing now, and nominal cash flow is the future cash flow based on the prices prevailing then. That means one is based on the current price level and one is based on the future price level. The one which is based on the future price level is the inflation adjusted cash flow or nominal cash flow, which in our example is $11,880, and the one which is without any inflation adjustment, that is the real cash flow arising in future, which will be the amount of $11,000. Now guys, simple logic is you are connecting a present value with a future value, and that connecting point has to come up with a discounting rate, correct? Present value and future value, when you convert one into the other, you need discounting rate. We have learned that in the previous class. That discounting rate, when it is the present value and the future value which is representing real cash flow, the connecting point has to be the real interest rate or real discounting rate, means it is inflation free discounting rate. Whereas if you connect the present value of $10,000 with the future value of $11,880, which is the nominal cash flow, the interest rate that can connect between these two will be not 10% but 18.8%, which is inflation adjusted discounting rate or nominal discounting rate. You can also call it as money discounting rate. Inflation adjusted discounting rate, nominal discounting rate, money discounting rate all represent the same thing, what is given over here as 18.8%. So simple point is, if you want to bring down the future cash flow into its present value, that is which future cash flow? The real future cash flow or simply the real cash flow to present value, the discounting rate will be the real discounting rate, which is 10% in our example. If you want to bring down the nominal cash flow to its present value, the discounting rate has to be the nominal discounting rate, which is 18.8% in this example. So if I just give you the whole content in some important bullet points, I would say $11,000 is future cash flow without adjustment of inflation. This is called real cash flow. $11,880 is also the future cash flow, but with inflation adjustment or with adjustment of inflation. This is called money cash flow or nominal cash flow. Real cash flows are future cash flows which are based on the prices prevailing today, and money cash flows are future cash flows that are based on prices prevailing then. So please write up these pointers and then I take you ahead. Alright friends, once you have completed writing this part of the note, let us move ahead and continue writing further. We have discussed these points already. To discount the future cash flow into present value, discounting rate is required. For discounting real cash flow, the discounting rate to be used is known as real discounting rates or real interest rates. For discounting the nominal cash flows, the discounting rate to be used is known as nominal discounting rate or nominal interest rate. Please write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this whole thing, let me take you ahead and now we discuss something very, very important. In our example, NDR, that is the nominal discounting rate, was 18.8%, RDR was 10%, that is the real discounting rate, and small I over here indicates the inflation rate, that is 8%. So if you want to compute NDR, you can simply pick your calculator, take 1 plus 0.1, that is 1 plus RDR, then to that you multiply 1 plus inflation rate, that is 1.08, correct? So 1 plus RDR, that is 1 plus 0.1, that will make it 1.1. Then 1 plus inflation rate, that is 1 plus 0.08, that is 1.08. When you multiply both of these, you will be getting 1.188. From that you subtract 1 to arrive at 18.8%, and that is how we compute nominal discounting rate, by taking 1 plus real discounting rate multiplied to 1 plus inflation rate, and from this whole thing you subtract 1. So I would say if I shift this minus 1 this side, what do I get? I get 1 plus NDR equals to 1 plus RDR into 1 plus inflation rate. Through this equation, if I want to find the value of 1 plus RDR, it will be 1 plus RDR equals to 1 plus NDR divided by 1 plus inflation rate. So if I want to find RDR through NDR and inflation rate information, I'll take this equation. I want to find RDR, So I consider the right hand side of this equation as it is. This one I shift to right hand side as -1. So I get RDR as 1 plus NDR divided by 1 plus inflation rate -1. And similarly, if I want to find inflation rate through this equation, what do I do? Left hand side it is 1 plus NDR already. I bring this 1 plus RDR to the left hand side. So in the left hand side it will be 1 plus NDR divided by 1 plus RDR, and what will remain in the right hand side will be 1 plus inflation rate. And then if I want to just compute inflation rate, that 1 plus I from that term, that 1 will be shifted to the left hand side again with a minus sign, so that will become -1. So in other words, if I want to find the inflation rate through the information of real and nominal discounting rate, I would simply take 1 plus NDR divided by 1 plus RDR -1. Now guys, I don't want you people to mug up this whole thing. I want you to carefully understand and write this, and if you want to pick any example to understand the whole matter, the whole example that we discussed just prior to writing this content, that example you pick up and try to connect everything, you will be able to find one rate from the other two. So 3 rates are involved: real discounting rate, nominal discounting rate, and inflation rate. If you have real discounting rate and inflation rate available, you can compute nominal discounting rate. If you have real and nominal discounting rates available, you can compute inflation rate. And if you have nominal discounting rate or nominal interest rate given along with the inflation rate, you can compute the real discounting rate through that. So I want you to just write up this whole thing, and that will be putting an end to this session.